The dragon economy was in slumber for almost 5 years. COVID and the slow post-COVID recovery in China cast a long shadow on global bets on the world's second largest economy. But the long-awaited stimulus last week has injected both hope and money into the Chinese economy and its stock market. Put together, $187 billion both in monetary and fiscal stimulus is a lot more than what was really expected. The deployment of this stimulus will eventually decide how sustainable China's next phase of growth will be. But as things seem right now, China's resurgence is imminent. This is mostly bad news for India, but perhaps a few silver linings could soften the blow. China's consumption rebound will mean more demand for its ailing real estate and auto sectors. These have traditionally been the harbingers of the dragon economy on its domestic front. The interest rate cuts and freeing up of statutory reserves at banks will push more money into the hands of the Chinese people and Chinese businesses. Cheaper mortgage for homes and exchange incentives on purchase of new cars and electronics will stimulate demand. This means Chinese factories will place bigger orders for metals which go into production, which will push global commodity prices up. This is bad news for India. India will have to shell out more money to buy the same material for its own factories and infrastructure building requirements. With China's rise, India's growth will come at a higher cost. Then there is India's pivot to manufacturing as a strategy. If Chinese factories spring back to life with the new stimulus, then the diversification to India or the China Plus One strategy may be pushed aside for now, or who knows, forever. India's pivot to being a manufacturing-led economy on the back of a sleeping dragon may remain just a pipe dream unless there is real value India could add. And finally, there are the stock markets. China stocks are on average cheaper to buy than Indian stocks offering similar earning potential. China's price to earnings, or the PE ratio, on the Shanghai Composite Index stood at 11.5 on 30th September 2024. India's BSE Sensex on the same day had a PE of 24.75. This means Chinese stocks trade at a mere 11.5% premium over their earnings as compared to Indian stocks being almost 25% overpriced. Now that China is likely to bounce back, foreign money will flow into the Chinese market as investors can get in cheaper than they would in India. But some market gurus believe that India could still be a recipient of passive funds that flow into Asia, even as a higher allocation would perhaps go to China.